All right, and I think we're live. Hi, everybody. Sorry for the slight delay. As you probably noticed, there's the two of us at the moment, myself and Dolph. Hopefully, Jared can join us as well. And Sean, unfortunately, has come down with the flu, but I hope he's watching and is going to ask questions. So welcome, everyone. This is another edition of the Flashpoint SAAS Lounge, which we're dedicating to venture debt. And the angle that I wanted to cover today, because we've done a few podcasts on venture debt in various formats, but today I wanted to talk about, or to discuss rather, what venture debt looks like from an investor's perspective. So we'll talk a little bit about the portfolio company angle as well, but really for investors in venture debt, what can they expect from the product? Just before we do some introductions, I'm told by my marketing team that there is some kind of giveaway of 25,000 Amazon Web Services credits. Now, I have no idea what that is, but apparently it's a great thing. And that's being given away to people who ask good questions. So we'll remind you again at the end, but feel free to ask questions as we go, because there is a prize. All right, so let's do some intros. Maybe Dolph, would you like to tell everybody a little bit of background about you and venture debt and how that all fits together?
Sure. Hi, everyone. My name is Dolph Hellman. I'm a partner at the law firm of Orrick, Harrington, and Sutcliffe. I'm in the San Francisco office, so it's morning for me, and good morning or good afternoon to all of you. So I've been practicing in the venture debt space for at least, I was trying to think about that last night, at least 25 years. I first started seeing the asset class around the late 90s, and it kind of developed in Silicon Valley and then expanded from there. And the idea behind it being that companies would want to obviously take on debt to the extent they could. But the problem they were running into was that from a banking or credit perspective, it's a little bit odd because you're making loans to companies that are not necessarily profitable, may not even have any revenue at this point, but have a great future or great supporters in terms of the VCs that are investing in them. So that was around the late 90s, and I've been doing it ever since. Our firm, Orrick, represents over 4,000 technology companies. And so I usually represent the borrowers in venture debt transactions, but I do have, excuse me, a fair amount of experience on the lender side as well.
Great. Thanks very much, Dolph. And just for those who don't know me, I'm Dennis. I'm the managing partner of venture debt at Flashpoint. So my job really is to portfolio manage the product and make good investments into very interesting portfolio companies. So look, let's just jump straight into it. And in terms of format, we'll cover a number of topics, but I want to make this as kind of as casual as possible. It is sort of 5 o'clock somewhere in Europe, so I do have my glass of wine with me. It's 7 a.m. for Dolph, so sorry, Dolph.
Yeah. Rub it in.
You've got a work day ahead of you, whereas this is the last thing on my to-do list today. But look, let's kick off, and maybe before we get into the nitty-gritty, just as a starting point, you're a startup, you've got a great product and a great vision, but you don't have earnings yet. You're losing money, you're burning money. Just in your experience, what instruments are available to this company? Like, what debt instruments? What is the universe out there that you've come across that these companies can use? To I suppose find something slightly cheaper than the very expensive equity that they have access to.
Yeah, well, obviously there are safes, simple agreements for future equity, which is basically equity-like, and there's convertible notes. Those would all be coming from investors or potential venture investors into the company. So the other option, as I alluded to a few minutes ago, is basically the venture debt option. And the reason it's attractive from a company's perspective is because it's less dilutive from an ownership standpoint than it would be if you were actually issuing additional equity. And the idea behind venture debt is that you want to basically extend the company's runway beyond a certain period of time, or either achieving a milestone or generating additional revenue, so that the company is basically has a higher valuation at the time it does seek additional equity. So venture debt kind of is that piece of the puzzle that kind of fills in that gap for companies that are trying to extend the runway before they do an equity raise. And of course, there's types of venture debt. The granddaddy of them all, I would say, is the growth capital term loan facility, which is basically it can be either a tranched facility or it can be a delayed draw facility, or it can be loaned up front. But basically, the idea behind that is you make a loan to a company. You basically don't require them to pay principal for a certain period of time, and sometimes it's just 3 months. Sometimes you see as many as 18 months. Which basically, again, because the idea is you're trying to extend a company's runway, it allows the company to preserve cash and not have to pay or amortize on the loan until a later date. So usually that date, like I said, is 3 to 6 to 12 to 18 months out. And then once that date occurs, then the loan starts amortizing. So that's the growth capital facility. There's also kind of normal kind of working capital or AR facilities where you borrow against the value of assets. You don't necessarily see that as much to the extent the company is still in a growth stage because they don't necessarily have revenue or enough AR or recurring revenue to support that model. But that is an option that some companies have. And then some companies that are very hardware intensive might do a venture lease. And that's maybe more driven by US tax laws in terms of the lessor or the lender being able to depreciate the asset as opposed to the company because they end up owning it still if it's structured a certain way. So those are kind of the options in terms of venture debt. Like I said, the granddaddy of them all, I think, is the growth capital term loan facility.
Yeah. Okay. And look, I think that's a great kind of overview. At Flashpoint, the focus that we have and within our product is really the term loan facility. As you said, that's kind of the main, I guess, the main thing that people associate with maybe with venture debt. I think a couple of the other things that kind of came to my mind as you were speaking, there's revenue financing as well that some companies in a particular business sector, like e-commerce, for example, can have access to. But that's more like a royalty. It's sort of not true debt. Companies can also use factoring to sort of sell their receivables, or that's like a working capital facility. But from my perspective, some of these are quite specific. So, for example, you need to have hard assets to have asset-backed debt. So that's one thing. The safes and the shareholder loans, the convertible loans, they're more like equity. So, they're actually in some cases more dilutive than the equity itself. So to me, the term loan, what makes it, I suppose, distinct is that it's a general purpose senior secured loan. It's not tied to a particular sort of aspect of the company. It can be used for whatever the company wants, and it's senior secured. So I think we're sort of on the same page when it comes to that.
And I think it's really important. Oops, never mind.
I was just going to say hello to Jared. Hello, mate. Hey. Just to bring you up to speed, so we've kicked off. We just had a very brief chat about sort of the types of debt that's available to startups. If you're a startup and you're thinking about where to get money from. And we've covered kind of the main things, like obviously venture debt, there's revenue financing, there's asset-backed debt, there's shareholder loans. But maybe, before we kind of jump into it, maybe it'd be great maybe to tell people about your background a little bit, and then your perspective on as sort of a founder and a successful investor, kind of how you thought about this when you were running InfoScout.
Sure, gladly. So apologies for being late. Quick background on myself is I've built a couple of SaaS companies, one from 0 to 40 million plus in revenue before exiting, and another 0 to past 100 million in revenue with a partial exit in the middle of that journey, which venture debt played a key role in. We were Series B funded, continuing our growth path, evaluating Series C opportunities. The valuations we were getting were not so attractive relative to the capital that we wanted to keep our foot on the gas pedal. We knew there was some strategic interest in the company that needed some time to play out. And so our options were to, if we wanted to keep growing the way that we were growing, we could either take a Series C at a not so great valuation and take that dilution, or we could explore venture debt. And really there was no other in between because of the amount of capital we needed. We needed many millions of dollars, and other forms of debt weren't going to cover us if we really wanted to keep our foot on the gas to keep growing at the rate that we were growing. And so ended up going the venture debt route very simply. It wasn't that simple in terms of getting my executives, my co-founders and our venture investors on board with the idea, but I laid out a bunch of scenarios in terms of possible outcomes. And in almost every possible outcome, venture debt turned out to be the best path forward, not only for the company, but also for its investors. And sure enough, 6 months later, that proved to be the case when we were acquired, and existing shareholders preserved about 50 million in capital as a result of having taken venture debt instead of the dilution associated with a Series C venture capital raise.
Yeah. And that's a great story. It makes me feel good that we're not just making money, we're actually helping create value for guys like you, right?
Absolutely.
And it's not the situation right now, this is actually something that we come across more and more at the moment. It's a situation where, good companies just don't want to take the dilution, particularly, early angels, because founders can negotiate ESOPs, but, earlier investors are particularly, hit hard at a time like this where, people have to take a valuation cut. So, I think it's a poignant story for the time of today. Okay, so maybe to the next kind of moving on from the types of debt that the companies can take. If we talk about this kind of traditional growth funding, which I think what Jared you used, and what Dolph you described as the granddaddy. What I suppose maybe Jared, from maybe going back to you first, as sort of a founder and a company creator, what are the things that lenders look for? What are the key things that the company has to be in the boxes it has to tick in order to get guys like me super interested and jumping over each other to fund you?
I can offer from my perspective what became clear is things that really mattered were one, we were demonstrating a business model that actually scaled, where additional dollars or euro in were actually going to result in meaningful incremental revenues with healthy gross margins, a la creating contribution margin in the business by putting that capital to work. And so a belief that this additional capital really would fuel continued profitable growth, profitable in the sense of incremental sales yielding incremental contribution margin to pay off SG&A. Second was, we already had some cash. It wasn't like we were using this because we were desperate for cash. We were using this because we wanted to keep our foot on the gas pedal and keep the growth story continuing. And I think, finally, we had strong venture investors. We had Bain Capital Ventures as our lead Series A, who followed on in our Series B. It was clear that we had strong backing from our investors. We had strong momentum. We had created something of value, and clearly we could go out and raise a Series C. So we had alternatives. It was just that venture debt was the best alternative for us in this scenario. Yeah,
and look, I think that overlaps like 100% to how we look at life, how I look at life. So the first thing you said was just sort of unit economics. Does every dollar you spend generate value, and how much that value is generated? So you've got to be able to do that in order to scale. That's a fundamental thing. Having VCs around the table for us is also critical, because we do take the risk that things don't turn out perfectly, and in 18 months' time you've got to raise again, right? So who's going to do that? And so having VCs that are institutional, that are hopefully have reserves and are able to fund is a key risk management tool for us as well. And also, we don't do bridges. So, it's not a good time. And Dolph, I think that's what you wanted to maybe comment on. It's not a good time to look for debt when you're desperate. It's a good time to look for debt when you have, 6-12 months visibility.
Yeah, at least 6-12 months. I mean, like you said, lenders do not like to make bridge loans. They don't like to be holding bridge loans. when venture debt becomes a situation where they've only got, 5 or 6 months of runway, it does become a bridge loan to them, and they look to kind of restructure it or make sure additional equity is coming into the company. But yeah, absolutely, the best time to get venture debt, and I think the time that venture debt lenders normally make loans is that it's on the heels of an equity raise, because they know that there's investor support there. Yeah, it's very important. And like you said, having one or more institutional VCs backing the company, doing follow-on investments in the company, I think is a good sign, because it's not impossible, but it's more difficult for the venture debt lenders to do the deep diligence that a VC investor will make. And it's because they're just making more loans to portfolio companies than VCs are investing in portfolio companies. So I don't want to say they just rely on the diligence of the VCs, but it is very important to have been vetted by an institutional VC, because they're going to kick the tires more so than a institutional investor will.
And I think as well as that, it's also the composition of the board with institutional VCs is always super helpful versus a bootstrapped company. And I think this is, I don't want to spend too much time on this, excuse me, because it's not really the main focus of today. But when for people who have companies or want to start their own business, I think there's always the temptation to bootstrap because you keep more of the pie. But at the same time, having VCs exponentially increases the value, and therefore you get more value from that. So I would just encourage people to think along those lines. And I guess, look, conversely, and again, maybe this is sort of me, and maybe you guys disagree, but in my mind, I always have a very distinct kind of, I guess, list of things that I feel equity should take in terms of risks, and very distinct things that I think venture debt or growth capital should take in terms of risks. And I'll sort of mention a couple, and maybe you guys can provide your perspectives. But to me, I guess, Jared, your story where you had a working, you had product market fit, you had a working business, you just wanted to keep your foot on the gas to just scale that, right? This is like bread and butter for growth capital. This is what growth debt is used for. For me, this is a no-brainer case, right? It gets a little bit tricky.
A no-brainer case for me at the time, quite frankly, and I'm a little bit surprised that it just hasn't caught on as a clear, better alternative in so many scenarios than traditional venture capital for these types of rounds.
Yeah, and look, I mean, I think in the US it's kind of more, maybe put on more, but in Europe, yeah, it does still struggle maybe with just the penetration and people's awareness of it, right?
Mm-hmm.
But you're right. In that situation, I think it's a win-win. Some of the things that I think are more in the category of equity risks, from my perspective, are, if you don't have the product market fit yet, you're still looking for it. That's an equity risk. So at that stage, we probably wouldn't look at providing a loan, right? If there's a major change to the company's strategy or geography, again, that's slightly more difficult for me to get my head around and understand that that's a safe risk. But maybe, Dolph or Jared, a couple of other maybe examples, or is this sort of exhaustive from your experience of when companies try to get debt, but what stops lenders from lending to them?
Dolph, why don't you take that to start?
Yeah, so I think you kind of hit the nail on the head. I mean, it's really just how the company's operating. You don't want to be funding a company that hasn't figured out what its vision is. If it's pivoting, that's maybe a good sign down the road, or a good decision. Time will tell. But in terms of trying to obtain venture debt, that's just not something that the lenders are looking for. Issues with management, dysfunctional board. I mean, it just kind of the usual things that you'd look for to make sure that the company's healthy and is going to thrive, I think, is kind of what drives the venture debt lenders.
Yeah.
You don't want to see a dysfunctional board, I think, in any company.
No.
Right.
It's not a good sign.
I would just second this idea that using venture debt, or assuming venture debt is a good vehicle to help your company pivot, is probably not the right way to think about it. That's and then second, if you're struggling to raise equity at any price, and then you're kind of running out of runway or looking for alternative options, again, venture debt is not this fallback. Well, if we can't raise equity, I do think I'd contrast that with the idea that you could raise equity, but the terms aren't great. The pricing's not great. Actually, in those circumstances, it can still make sense to pursue venture debt. And in fact, the value proposition can even be multiplied sometimes as a result of that. And I'll say that was just very true in my own case with my last company. The terms we could get just weren't great. And so what it meant was the value proposition from venture debt was even multiply stronger. And there's a reason that it preserved so much capital for our investors 6 months later when we went through a partial buyout.
Yeah. And look, and it can be a mix, right? If the terms aren't quite right, I think you said it right. If you can't raise equity full stop, that's a big red flag for anybody, right? If it's a bad time in the market, you can raise equity, but you don't like the conditions, then yeah, venture debt is a possibility, as is a mix. Maybe you do take a bit of equity for strategic reasons or whatever, but then you just offset that with a bigger chunk of debt to reduce the impact.
I'm advising a startup on that very strategy right now, in terms of their approach of basically
put me in touch
offer
with them.
their runway, ensure they have sufficient capital.
Me too.
But don't do it all via venture capital. Take a slightly smaller round in the dilution there and supplement it with venture debt. Great.
Okay, so look, I think that's a good, I guess, primer of how we fit into the ecosystem. We as venture lenders, from the founder's perspective and from an advisor's perspective, maybe worth talking a little bit about venture debt as an investment class. So from the point of view of investors, and I think the one thing that we always, or sometimes we struggle with, is are you taking equity risk? What's the risk? What's the downside of these loans? And maybe Dolph, this is sort of one for you to comment on, but because you sort of write the documents that provide us with the protection, but with these growth loans, how is the downside protected? How do we protect the principal with them?
Yeah, so the first important thing to keep in mind is that it is debt and it's secured debt. So because it's secured, to the extent there is some sort of liquidation or wind down of the company, the lender is going to get paid first from the assets that it has leaned on. So that's critical. And obviously a lot of times the most valuable asset might be the IP, but there still may be equipment or other tangible assets that might help the lender get made whole. Second thing is there are sometimes covenants, minimum cash covenants, that kind of goes back to the point of the burn that we were speaking about a few minutes ago, which basically says, if your cash drops below a certain threshold, then we have a chance to kind of re-examine the company, declare an event of default if we need to. But it gives the lender some sort of hammer to basically, force the company to come to the table and come up with a new deal or a new structure. And then I think there's ways within the documentation that you can minimize risk. And one is kind of milestone-based tranching of the facility. So a lot of times I'll see, a facility may be a $10,000 growth capital term loan facility, but only $5 million will be available at closing, and the remaining 5 might be triggered by either a raise of additional equity or some sort of milestone. It kind of depends on what the company's business model is, but something that shows that there's traction there, right? So I think that kind of protects the downside risk. And then obviously the fact that the loan amortizes. I was trying to think before we got on the phone or the Zoom or the video today. I was trying to think about how many downside or how many kind of workouts that I've seen. And I've seen my fair share, but it's usually been a situation where the equity investors are no longer supporting the company because the business model doesn't make sense. So I think having those types of milestones that are tied to a success in the business or some achievement by the business is a really good way for the venture debt lenders to protect themselves from downside scenarios.
Yeah, and look, we use all of that. We do typically tranche these loans. We like to do follow-ons, which means that you start with a smaller loan, and then as you kind of see the company develop, you increase the exposure. Just one thing maybe to dig into before, Jared, we get your perspective. The covenants to do with the cash runway. I think this is an interesting one because we've been in a few situations with that sort of construct, and inevitably there's a conversation with kind of the founders and the equity to say, well, look, guys, when we need you most, you're kind of hitting us with the covenants and with the default, right? So, and it's kind of like we've also seen covenants to do with, I think, with revenue growth. So, for example, amortization happens once revenue stops growing, and so the companies all say, well, okay, we kind of need the cash when that happens, and then all of a sudden you start taking all the cash away. So, how does that dynamic play out in your experience when you're in the middle of these sort of negotiations?
Well, I mean, it depends on what side of the table I'm on, right? So if I'm representing a bar where I'm trying to fight against having any sort of, financial covenant at all, I mean, I think it's also important to keep in mind that there are subjective events of default that the lender keeps in its back pocket. The two main ones being material adverse effect event of default, which is very subjective. There's been some sort of material adverse change in the business operations condition, and it usually says financial or otherwise. So it's a very broad mandate in terms of what could constitute a material adverse effect or a material adverse change. It's the type of event of default that I would say a lender will not necessarily rely on, go to the bat, so to speak, to make sure that they're comfortable, declaring event of default and foreclosing on assets. But it is one that they can use to kind of force the company to come back to the table and renegotiate either some sort of requirement that they raise additional equity or whatnot. And then there's another subjective event of default that you often see called investor abandonment. And it's not a guarantee by the investors. Sometimes the investors are concerned that they're being required to guarantee the debt of the borrower. That's not the case at all. But it's really just a conversation that the lenders want to have with the VCs that say, hey, are you going to continue to support this company? Yes or no? And if the VCs say yes, then there's some implicit understanding that when things get tough, there's going to be additional equity coming into the company. If they say no, then obviously, if they say no, then obviously it's going to be some sort of wind down situation. But hopefully the lenders, caught that early enough that they're, if not made whole, at least close to being made whole. So there's lots of little, triggers or levers that you can use as a lender to protect your investment.
Yeah.
I'll just offer a different take from an entrepreneur's perspective, which is, do you really believe that you have a business model that can continue to scale from the standpoint of you've got sufficient product market fit, there's sufficient market, obtainable market out there still to pursue, that putting additional money into sales and marketing is actually going to yield incremental revenue that has positive unit economics, that the unit economics of your business make sense and they scale with the business? And if you as a founder actually believe those things to be true and you just need additional fuel to put on that fire, then great. Venture debt can be excellent for you. If those things aren't true, don't look at venture debt as this sneaky way to bypass venture capital to fund a business while you try and figure all of that out. That's a mistake. It's not the panacea for that problem. It is a capital preserving mechanism to keep your foot on the gas pedal when you have something that's working and you want to keep it working and buy more time without diluting yourself and your existing shareholders nearly as much.
Yeah. And maybe in terms of kind of the protections from the lender's perspective, when you did use the venture loan to extend your runway and then to get to that successful exit that you had, just again, typically, what were the key things that the lenders focused on in terms of protecting? I mean, they were clearly comfortable with the company, so this is if the company doesn't quite fit that bill, maybe there's a whole suite of things that the lenders will ask. But just from the perspective of a company that kind of ticked all the boxes, what were the things that they focused on in terms of just protecting their capital?
Yeah, I think one of the key things was just making sure our cash balance didn't run below a certain level. And that was kind of based on where we were at in terms of burn rates and other things, that they wanted to make sure that there was still, some level of runway left to course correct, and for them to get involved in helping make sure that course correction happened. If for some reason our cash dropped below a particular level, I can't remember the threshold anymore. But fundamentally, that was the key term. We didn't have set growth targets that we had to hit, or revenue targets. We didn't have certain gross margin targets we had to hit. At the end of the day, fundamentally, we did this well enough in advance, and we bought ourselves enough runway that it was really just a question of could we continue to pay back the debt and have cash remaining in the bank.
Yeah. Okay. And I guess that cash balance would have been, kind of 3 or 6 months worth of burn or something like that.
It was roughly 3 months, as I recall. Yeah. Mm-hmm.
Yeah. And what did the lenders want you to do if you were to breach that? Was that presumably it wasn't an event of default. Presumably it was an obligation to do something or to get them involved, or did they have a bigger say in at the board, or what happened?
Yeah,
what happened, brother?
And forgive me, I'm trying to remember fully. What I do recall is there would be a board meeting where they would be present and involved with the other key investors to discuss, course of action and other matters. And so they basically gave themselves a seat at the table in that situation.
Yeah. Okay. I mean, look, I think again that aligns very neatly with how we look at life as well. At Flashpoint in terms of our product, we very frequently, the way that we credit assess these companies is, along the lines that we've discussed. But fundamentally, if you're in a situation where the company has 6 months of cash, you want the company to start doing something. If it's not already, a good company probably has already started raising a round or doing something.
Mm-hmm.
But if it's not done that already, you want them to start doing something, and you want to be able to. You sort of put them on your watch list, and then you want to be more active in that process. And fundamentally, you can either raise more equity, or you can sell the business. And so those two things are perfectly fine with us, but the company has to actually do those things. So I think that's how we look at it as well. Okay, Dolph, anything to add to that before we move forward?
No. I think sometimes a lender may require there be reduction in force just to kind of cut the burn. But yeah, like you said, yeah.
Yeah. Okay. And look, and I think this is all sort of how this works in practice. But I think it's also, excuse me, useful again just to bring it back to an investor's perspective. What does that actually mean for for how many bad loans are there in the portfolio? What's the average default rate? What's the loss rate? And maybe Dolph, I know that industry stats are a bit scarce, especially now that Silicon Valley Bank is no longer around or giving stats. But in your, I suppose, experience, 25 years doing this, what's your sense for how often these things blow up?
Yeah. So one thing you mentioned it earlier, you used the term ecosystem, and I think the fact that it is an ecosystem, I think, is very important because lenders are very careful with who they're lending to, and there a lot of times there's relationships between certain VCs and their portfolio companies and certain lenders. So the VCs don't want to alienate the lenders by having one of their companies go into default and have the loan completely wiped out. At the same token, the VCs or the venture debt lenders don't necessarily want to pull the rug out from a company sooner rather than later. If there is a possibility that the company is going to do well. So I think that's a very important point to kind of keep in mind, is that, this is an ecosystem and that, the players have to work together. So, that I would say that's probably the most important thing in terms of how all this stuff works.
Okay. And I guess when things have gone wrong and there has been a workout situation, again, in your experience, and very, very high level and broadly, what's the lender walk away with? So are they made whole, or what's the sort of haircut that they very, very broadly that they can expect?
Yeah, I mean, so it kind of depends, right? Because it kind of depends on where they are in the loan. So I didn't answer your first question, which was kind of what the default rate is. I think it's in the 5% sort of range, something like that. And I think the reason it's relatively low is because there is a symbiotic relationship or ecosystem that the VCs and the venture debt lenders and the companies kind of all understand how things are supposed to work. But I think also the fact that you have maybe upfront fees that are paid in terms of putting the loan together, you've been paid some interest, presumably over time. The rates are relatively high. I mean, relatively, I guess it's tough to say, but it's in the teens usually. Depending on what the underlying, cost of capital is for the lender. So there could be, even if a loan, defaults, 12, 18 months into the the lender is not completely lost. They haven't lost 100% of what they've invested. It may be more like 50, 40%, that sort of thing. So I think again, how their loans are structured is very helpful in minimizing the potential loss that a lender could incur as a result of a defaulting loan. So
yeah. Jared, any perspective on that?
Not on that bid.
Yeah. Okay. And look, maybe then I'll add 2 cents from my perspective. And look, I think if you do look at the SVB stats, because they did used to publish sort of very nice, kind of cohort stats even. I think the default rate is actually in line with Dolph, what you mentioned. So in my mind, it was something like 5 to 10%. So that's the number of loans that actually, default on a payment, which is, to me was actually lower than I thought it would be, given that, intuitively, if you're lending to companies that don't earn any money, 5 to 10% default rate is pretty good. And then the second point you made I think is very important. And I think that point is a little bit undervalued by investors in this product. And that's how we look at it as well. Because when we make a loan to a company and it ticks all these boxes, we really consider the first 12 months or 18 months to be off risk, because it's got the runway. Once it gets to that end of that runway in 18 months time, that's when the first risk point for us hits. That's when it has to raise more equity, right?
Mm-hmm.
In most cases, most of the companies that we look at, we know who the VCs are, and we have a fair amount of confidence that those VCs will not simply abandon the company after 18 months, unless the business model is like broken somehow, unless that changes completely, right? So even after 18 months, in most cases, there is even if the market is terrible, there's an infusion of maybe a bridge or some sort, or a short-term or CLA from the existing VCs, which gives the company a bit more time. And then the true test happens, once that runs out, right? And by that time, as you said, cash on cash, we have, 50, 60% of the money back, right? And so, and then we recover maybe something through the liquidation process. So, the capital loss that a venture lender experiences in one of those 5 to 10% default cases is not it's not a bullet. It's not the full thing. It's maybe 30, 40%, or if that. And so to me, this is actually something that's not intuitive, and people may not appreciate, is that the loss rates, which is the default rate times the loss, are actually quite low, right? On a portfolio level, you might see something like 3%, 2% of the capital that's been invested, right? And if you benchmark that against, like a listed, like a public debt instrument, that's, not far below investment grade, actually. So it might be like a BB bond or something.
Yeah.
So this is kind of how I think about it. And to me, kind of the combination of that, that loss rate versus the return that you expect to make is quite an interesting combination.
We haven't even talked about equity kickers and warrants.
I was that's my segue. So look, I'll give you the floor to talk about that then. So warrants come with every venture loan. Sorry, Jared, maybe I'll go back to Dolph first, and then we'll come back to you on warrants and get your perspective. But what's the sort of range of structures you see for warrants, and how do they work, and maybe just give people an idea?
Yeah, so to kind of back up and define a warrant. So a warrant's basically an agreement between the company and the investor, in this case, the venture debt lender, to basically be able to purchase stock at an agreed price. It depends if it's a preferred warrant or a common warrant. If it's a common warrant, it's usually based on the most recent 409A valuation of the company. And if it's a preferred stock warrant, then it's either based on the most recent round, or if there's a down round in the future, the next round is a down round, then it would be based on that down round price. Sometimes you'll see penny warrants, but I would say more often than not, it's either 409A valuation or the preferred stock price. In terms of warrant coverage, it can vary, but sometimes it's usually based on a percentage, either a percentage of the loan amount, if it's a preferred warrant, or if it's a common stock warrant, it's usually based on a percentage of ownership in the company. So the way I think about it is, if you were a pre-seed investor or seed investor, and let's say this company is a Series B company, At the point in time where the Series B is occurring, the pre-seed's probably getting maybe owns a half a percent of the company, or maybe 1% of the company, you know, that sort of thing. That's kind of what the warrant coverage would end up being like. So you're, as a lender in this asset class, you're getting a return in terms of interest rate, which is relatively high. You're getting your capital back in most instances, and then you're getting a percentage of ownership in the company. And, you know, truth be told, I mean, a lot of venture debt lenders have made a killing on companies that they've invested in as lenders based on the warrants that they've received. So it really is, it's an equity kicker. They call it a kicker because it really is a kicker. It can really juice the returns of the lender or whoever happens to hold the warrant.
I think our lender went from probably being in a position to make kind of 13% to making 18%, but making the 18% within 6 months.
Right.
You know,
Right.
on the money, thanks to the warrants.
Yeah. And the warrants usually stay in place for between 10 to 12 years. So, you know, and if a company's acquired, then the warrant converts, or they get cashed out. Sometimes you'll see warrants cashed out in terms of an M&A transaction or whatnot. So it's a great thing to have. It really juices the returns.
For sure.
Yeah.
And again, that 18% in 6 months was still way cheaper for the company that taking on the loan than had we taken equity.
Well, absolutely.
So-
It implies that the equity value has gone up quite a bit if the warrant added, you know, 6% or 5% to the total return, given that the warrant is like 10, 12% of the loan. So do you see, just in terms of monetizing the warrant, because this is something that, you know, people that, well, our investors are, you know, it's a question that they often ask, you know, oh, you invest in a company, you've got 4 or 5 years left on the fund, you know, who knows what's going to happen. How have you seen, maybe again, Dol, from your perspective first, have you seen much trading in warrants, or is this sort of not very common at all? Can warrants be monetized without actually being exercised?
Well, a lot of times it depends on what the warrant says in terms of right to transfer. Sometimes, you know, companies are a little bit concerned with who's holding their equity or even their right to equity. You know, it's an asset, obviously, so there is some possibility to have a secondary sale of it. I don't see that necessarily in my practice very often. I think if it wouldn't be a one-off. I don't think. I think if you're going to sell warrants, I would think that it would be done kind of as a pool of warrants for different companies. I mean, valuations are always difficult with emerging companies, so that's part of the problem. I think is that coming up with value to figure out what a fair sale price is. But it is an asset, so you know, all things considered, it could be monetized even before exercise, I would think.
Yeah. And I guess, Jared, in your case, did you restrict the lender in terms of who the warrants could be sold to or assigned to?
Forgive me, just don't recall. It's lost in the fog of the time.
Exactly.
You had the exits, you know, you've had the celebration now.
Exactly.
It's just,
It all
just
went well. That's what I
sack of
remember.
money in the bank.
Everybody was happy.
Yeah, that's what your lawyers are for, is to protect you, you know, make sure it's not assigned to a competitor or that sort of thing. That's usually what the restriction would be tied to. Yeah.
Yeah. And that's a very common thing that companies ask us for. We try to keep it as flexible as possible. So for us, having multiple avenues to get cash for the warrants is critical, because we can't always rely on that being an exit event. And you could always exercise the warrant as well. You don't have to sell the warrant itself as a warrant. You can exercise it, you know, which means putting cash in, but then you can sell the shares as a secondary. It's a little bit easier.
Although usually the warrants provide cashless exercise, right? So you can offset the price of the warrant, you know, so you get fewer shares, but you don't have to come out of pocket for any cash.
But that means an independent valuation, and sometimes companies don't. That's another can of worms, right? But I agree with you.
Yeah.
So cashless exercise is great for a fund that's probably past its investment life and can't sort of draw more money. And that's what we try to do as much as we can. Cashless exercise, you know, or exercise the warrants for cash and then sell them, or sell the warrants. And typically companies do ask us to, you know, to restrict it from direct competitors. So not too broad, but direct competitors, they don't want to give shares to direct competitors. So that's kind of customary. But I think, Jared, your case is, you know, a good case in point. And from a perspective of like a portfolio manager, for me, I don't need every warrant in my fund to be, to give me that sort of boost. But if there are, one, two, or three that really perform, that's a material boost to the fund's performance, right? And that's why I think it's a free kind of option. I mean, you could argue that it's not free because it's priced into the whole package, but at the same time, there's no downside to it. It's a simple upside kicker. So it's a very nice instrument to. And from the point of view of dilution, it's only 10% of what the equity would do. So it's sort of not too painful.
Really minor. It's a non-factor.
Yeah. One other equity kicker that sometimes you'll see is a right to invest. So sometimes venture debt lenders will negotiate a right to invest a certain amount of dollars in the next equity raise. It's it's an option basically, which is they don't have to exercise it if they don't want to, but it's another way to juice returns if they think the company is going to perform really well.
Yeah, and that's a great point, and I actually didn't think of that. But with our funds, and I think generally as market practice, venture debt funds can invest a small portion of the fund in equity. So in our case, it's something like 5% of the fund can be in equity, and it's equity of companies that we know. So it's not just sort of random equity; it's equity in the portfolio companies, which is another way to to really, because if you do a follow-on or whether it's a loan or equity, you're just in a much better position from a risk perspective, right? And this is like the business model that we have. You when you make your first loan, you're still an outsider. You have information, you do due diligence, but you don't know, right? Once you've been with the company and you've sat on their board, even if it's as an observer, for 12 months, like exactly who the performers are and who are the ones that you have to kind of watch more carefully. So for us, using kind of that arbitrage, if you will, aside from the fact that on its own, the product I think is a very good, interest risk return, profile. I think that's another kind of way to really boost that from a portfolio manager's perspective, I guess.
Or even investing in serial entrepreneurs, right? So like, let's say you invested in a company. Yeah, exactly. That person, their MO. It helps minimize the risk.
Yeah, and you said before, like it's an ecosystem, and the VCs and debt providers, and this is sort of a segue maybe into my next point. But there is a large element of that, and VCs are comfortable maybe with lenders that behave,
rationally.
I guess, rationally when things don't go well, which sometimes is difficult, right? And they like to do business with us lenders, and we try to be that lender. And they don't like lenders that are sort of have a vulture mentality that sort of lend to own, and certainly we don't do that. And so working with VCs, working with founders, so Jared, if you have another startup, please tell us.
We'll get there in a year.
Yeah. Okay. Good stuff. It's just part of it. I would say it's a less commoditized ecosystem or product than perhaps other forms of direct debt. And maybe as a segue, and I'm not sure if this is, if this is something we can go into detail, and maybe it's not the right time or forum, but often people ask to compare us to other forms of direct debt and say, well, I do, sort of PE sponsor-led, loans, and that's got a certain risk return characteristic, or I do, another just sort of direct debt, through some other form, or maybe distressed, or maybe mezzanine loans. Do you guys have any? And again, I appreciate maybe this is a bit left field, but do you have any sense for how venture debt, just as a product, from a risk return perspective, fares against those other forms of debt that people would have access to?
I think it compares very favorably. Yeah.
Yeah, I don't have a broad market perspective. I have my own personal experience. I got so much value as an entrepreneur out of the venture debt that as soon as I made the money on the exit, I immediately went back to my venture debt lender in the US and said, I'd like to be an investor in your fund because I see the value that you create. I see how you made money. I see how I, as a customer, made money. I see how my investors benefited from this. And I can just say over the last how many years, 8 years now, it's been a fantastic part of my portfolio in terms of its performance through all kinds of market cycle activity.
Yeah.
All appreciate is taking place over the last 8 years. And so to me, I do angel investments. I'm an LP in some venture capital funds, but I'm also an LP in a couple of venture debt funds on both sides of the pond, including Flashpoint. And so, from that standpoint, I think it's just it's a great part of my overall portfolio strategy of risk reward here across the spectrum, all the way into municipal bonds and corporate bonds and other things and blue chip equities. But for me, it fills a great place in the overall portfolio, and its performance has been outstanding over the last 8 years.
That's fantastic, mate. I'm happy to be part of that, and we'll do our best to continue on that path. And just the last point, I think we're close to the end, and we want to leave some time for questions. I just think, and Jared, you alluded to this just now. I just think that this is because it's an ecosystem that's maybe distinct from the broader market. To me, it's a very good diversifier. For whether it's you look to just diversify a debt portfolio or just generally, this is a product that's not really fully correlated to anything else.
Right.
You could argue that it's correlated maybe to the tech kind of universe of things, but at the same time, not directly. There's time
not directly, and the timing of how that plays out is actually not correlated. So
exactly. So that's I'm an investor in my own fund, and I like having that as part of my portfolio as well. And so look, I would maybe finish this podcast with that thought. I think if there is we've covered a lot of ground. We've talked about what sort of companies we invest in, what we look for, what protections we have. We talked about default rates and loss rates, and I think the overall message for me, from me to potential investors and generally to people, is that it's an asset class that I think is a little bit underappreciated as an investment class, because from a risk return perspective, it stacks up very well against any other fixed interest instrument you can think of. And it's a great diversifier. So, give it some thought. And I think I'll maybe give, you guys a chance to comment if you have something else you want to comment, but I think we should probably open for questions shortly.
Yeah, just one quick comment from me. So here's a sign that it's always been kind of a hidden gem in terms of investor perspective, venture debt. But last year was the first time there was a venture debt conference that was actually held in New York, and I think it drew probably 250 people. So the cat's out of the bag, so to speak. I think people are understanding that this is a very lucrative asset class if you pick the right partner. So yeah, it's definitely a way to diversify your portfolio, and returns can be really, really good.
Agree completely.
All right. So I think we'll pause there. I can't see the LinkedIn, so if there are any questions, but Dana, if you can let me know if there are any questions. I'll just, again, the marketing team is telling me to remind you guys about this Amazon Web Service credits giveaway. I still don't understand what Amazon Web Service credits are, and maybe I should. But but there's a giveaway, so it's since we have no questions, I'm just going to keep these credits unless somebody asks something.
Can I ask a question? I'll use the credits for my startup.
Sure. Your job is to answer questions, mate. This is that's the deal we had.
All right, guys, give me an example where there was just a fundamental misalignment at the end of the day between the entrepreneur raising the venture debt and the venture debt firm or the investors. Where there was a misalignment. Maybe it was avoided from the standpoint of no deal was ever signed because of that misalignment, or maybe things went through and it was discovered later. Yeah.
Well, look, I think we do our best to spot these things before we invest, obviously. And so I'm just trying to think of of cases where we almost invested, but then pulled out at the last minute for whatever reason. Maybe we discovered something. I mean, look, I had this conversation the other day with somebody, and they split the world into two types of lenders. One was a cap table lender, and another one was sort of a lender against the quality of the business. And we're very much the second type of lender, even though obviously the VCs are important. And so there've been a few cases where we had companies brought to us by very well-known VCs. So really kind of tier 1 or tier 2 global VCs, with, where the company had good growth. But when you dig into the unit economics and you sort of start figuring out that the company is buying growth. It's not generating value additive growth. And we tended to, we sidestep those. So it doesn't matter who's on the cap table, but if we see like an investment that ticks all the boxes except for unit economics, and we fundamentally don't understand how the unit economics work, then we just don't invest. And maybe the hype is enough that they'll keep raising money, and that's okay. We're happy to miss out on those. But at the end of the day, like, I really think that if the company has a quality core, so fundamentally its product and the marketing that the company does is accretive, there'll be lots of options for it. It's worth something. It can be sold, it can raise money. Whereas if a company fundamentally is just buying revenue and there isn't that accretive engine in the middle, you're just playing musical chairs. Like, when the music stops, someone's going to be holding the bag, and I just don't want to play that.
Makes sense. Thank you.
The credits are yours, mate. Okay.
Yeah.
Okay, guys. Well, look, thanks very much for joining, and thanks everybody who's watched. Let's do this again sometime, guys, and have a good evening. Cheers.
Likewise.
Cheers.
Cheers.
Take care, everyone.
Bye-bye.
Bye.